Yeah, 100%. I mean, you're a product of the five people that you spend your time with, right? As Jim Rohn likes to say.
Yeah.
And I'll give listeners like a nice little way that you can kind of, encapsulate what, our definition of net worth. Net worth is equal to your financial IQ plus your mindset IQ plus your physical capital plus your relationship capital. When you can put all of those things together, that's how the billionaires are playing the game.
Well, hey, Dave, thanks for joining me today. I'm super excited to get in this with you and dive into a bunch of stuff. But thanks for your time today, and welcome to Getting the Cash Flow Game.
Yeah, grateful to be here, Kenny, and looking forward to the discussion.
Well, first and foremost, I just want to say, because I'm here in San Diego, so we're a big military town, and I just want to say, hey, thanks for your service. I know it was a while ago, we were just chatting about it, but thanks for your service and thanks for what you did for our country. Because to me, when I live here in San Diego, we've got a lot of Navy SEALs and badass guys here, so we're surrounded by them. So they're some of our tenants, and so, anyways, thanks for your service, and nothing but gratitude there.
Yeah, you bet. Really appreciate that. And it's kind of interesting, right? Because freedom isn't free, right? And, in this world that we're in terms of trying to create financial freedom and really building wealth, wealth is really just a means to actually start to drive, right, these freedoms that you want in life. So, I'm grateful to have had the opportunity to travel, work with some amazing people, and see the world. So appreciate it.
Yeah. So, man, your story is really cool, and I think it can resonate with a lot of people, because I feel like I was reading a little about you today, and it seems like some point in your life you kind of had a mind shift. But if you can kind of take us back through when you kind of had that mind shift and kind of how you landed here today.
Yeah, absolutely, Kenny. So, I did the Marine Corps in the ROTC program, and I was raised in a middle-class family. And, I was taught that the recipe for success was go to school, get good grades, you're going to get a job, and, life is just going to work out, right? So I kind of, went down that path, did the Marine Corps for about 4 years. And really learned also some amazing things in the Marines that they just don't teach anywhere else. So things such as leadership, teamwork, and integrity, right? And then afterwards, I transitioned into corporate America, got into the tech industry, and spent a couple years there kind of getting frustrated with that whole corporate machine, right? And bureaucracy that was there. And then in 2000, on October 24th, 2000, Kenny, we had an 18-month-old, and then my wife and I literally hit the baby lottery and had triplets,
Wow.
which was just, I mean, if anyone out there has kids, you could just imagine. We couldn't even figure out, our first child, and now we just quadrupled the size of our family. But the most immediate thing that really came to my mind, besides, changing diapers and all that, was how am I going to provide for financial security for my family? Right. And so, the next day I went to see my financial planner, and he told me like the same thing that all of them had told me: just max out your 401k. You're going to get a 7% return. That's really good. You've got kids now. They have these great things called 529 plans. You can invest in those. And so, it was at that point that I just got so frustrated with conventional financial planning. And I thought that, what? The top 1% are not building their wealth as a retail investor in the stock market. So how are they doing that? It really launched me on this kind of obsessive journey to figure out, how are the top 1% building their wealth? What kind of things do I need to look at? So I started investing in all kinds of alternative asset classes. And keep in mind, this is back in 2000. So Rich Dad Poor Dad had literally just come out like the year before. There weren't many, resources available. So, lots of networking things, but invested in a lot of asset classes over the years. Made the transition over to the entrepreneur side a few years later in the tech business. And so fast forward today, 20 years later, I really have instantiated all of those lessons and learning in what I call the holistic wealth strategy, which is kind of a framework for building real legacy wealth.
Yeah, I mean, that's a great story. So really the shift was you had triplets like a lot of people. and you're like, this traditional way is not going to really work. And you just kind of figured that out. So can you kind of tell me, holistic wealth strategy, which is kind of cool. How did you kind of come up with this concept? And then I know it was a while ago, but was there, I mean, it was funny. I always talk to people in real estate. Was there a book? And a lot of people go, Rich Dad, Poor Dad. Rich Dad, Poor Dad, I don't even think it's about real estate. It's about a mind shift, right? To me, it's not like he's sitting there, here's the ABCs of go build real estate. It's more of a mind shift. So what was the mind shift? What was it for you besides the triplets? Was it a book? Was it a mentor? Was it watching somebody in your life?
Yeah, I think it was kind of a culmination of things that was really my, pivotal moment, right? That transitioned me then. Rich Dad, Poor Dad was interesting, but there was no how-to in that book, right? It's very conceptual. And when you read the cash flow quadrant, that's amazing. That really illuminated a lot of things for me, but I didn't know exactly, hey, how am I going to get there? Right. And then, the reason why I wrote my book is because, I've done well investing alternatively for the past 20 years. And I wanted to help other people do the same thing. So the book really began literally as an infographic that I put together because I was trying to explain people, how do you actually invest in these different, alternative asset classes? And frankly, it's a whole alternative strategy, right? It's not just investing in that next multifamily deal, right? But there's an overall strategy that includes, again, holistically. Right. You need to have your wealth encompassed in your health encompassed in that. You need to have your mindset in that. You need to talk about, removing your top wealth destroyers. You need to talk about, tax planning and infrastructure and things like that.
Yeah. And it's a lot of people, in my life here, I'm here in San Diego, and we've been in the real estate business for 20 years, financing, we manage, we, obviously invest, and a lot of our investors here, they don't raise money. So we're around, when I got in this, we're around different people where it's like the guy owns 1,000 units, 2,000 units plus, and it's their money. They built it. It wasn't syndicator, but we always were talking about, I feel like people have a different relationship with money. So a lot of people in real estate, they make it, and it's amazing that they don't go out and invest it, but they'll tell somebody else to. Or we know commercial brokers that have been doing it a long time and they never bought an apartment building. We're like, wait a minute, what? How's that possible? So yeah. And the other thing is, a lot of the real estate investors I talked about, they're just all in the one sector. They're all in a real estate, but that's not you. You kind of you're into real estate, but you're also in other things. Can you kind of talk about some of the asset classes you're in and why did you pick those?
That's such a great question, Kenny. And I'll really break this down for investors. And the reason, so we're basically focused on three different sectors. We're focused on real estate. We're focused on energy and private credit and private debt. Those are the main things. And then we also help clients with whole life insurance policies on the infinite banking side. But the reason being is, so I just had Michael Sonnenfeld was on my podcast a couple of weeks ago. He's the CEO of Tiger 21. They have over 1,300 members that have an average net worth of over 100 million. Okay, so it's fascinating when you actually look at their portfolio allocation. And I would consider these guys to be, best of the best in terms of, money producers, wealth creators, right? Their exposure to the equities markets is literally only 22%. They have about 25% then allocated into real estate, another 25% into private equity, and there's some fixed income and some other things that kind of fill in the remainder. And when you start to study the balance sheets of the ultra wealthy, you realize that even if you love the real estate asset class, right, you still need to be diversified in that. And we're seeing that play out right this year with the recent rise in interest rates and how the market is right now, right? You need some diversification. And then, the energy sector, what I find fascinating is, we have an oil and gas fund. And when you invest in oil and gas, if you have active income, you can actually offset 100% of your active income investing into oil and gas, right? And a lot of people don't realize that. They understand the passive losses, on the real estate side, but we have a lot of high income earners, right? So if you can reduce those taxes, just think about if you were able to reduce your taxes by another 10% a year, like perpetually, and then reinvest that into deals. I mean, you can significantly grow your wealth, right? So that's why we like the energy sector as the second one. And most of these attributes around these sectors, I say from really a macroeconomics standpoint, the fundamentals are really strong. It doesn't matter what job you're in, where you live in the world, anything, the demand for energy is only growing.
Yeah.
And, you know, I support green initiatives all the way, but we're just not there. You know, so I think there's going to be some time still to invest in this sector.
Yeah, one of the things that caught my attention you said you invest in is I wanted to go back was the debt. You're investing in the debt markets.
So, and I'll tell you, this is kind of unique, right? I'm not sure if you're familiar with this. Have you heard about the merchant cash advance business and what that is?
I've heard of it. I'm not like I've heard of it for sure.
Okay.
I'm not like,
yeah. So I'll break it down really quickly. I mean, it's really fascinating, right? Because a lot of people are investing into debt, which is, you know, backed by real estate, things like that. Well, in the private credit world, we're really taking advantage of the banking sector fallout, right? But you have all of these small businesses that are growing out there, and they need additional capital to continue to grow. Well, if you don't have the greatest credit rating, or, you know, let's say you're a restaurant owner and you have 3 locations there in San Diego, you know, you're running things shipshape, profitable, doing well. You want to open the 4th, right? Where are you going to get the funds to do that? Well, we go through an underwriting process that's really scrutinizing, you know, takes them through that. We can literally fund like within a week. So then that business owner can get the capital to go build that 4th restaurant. And then they pay back the terms on an average of 7 months. Which is, you know, very strong returns. You know, typically we're seeing around a 35% in terms of a factor rate that they're paying back in 7 months. So as that money comes back into our fund, you're getting paid principal and interest literally on a daily, weekly basis.
Wow.
It's coming off of their accounts receivable and going directly for you first, right? So we're able to actually take that capital and then keep recycling it into the next opportunity. So there's a ton of velocity to this, and it's just very well structured for, you know, for high income producing cash flow.
Yeah, because I mean, there's a lot of money. I agree. We have a friend here that's a large syndicator here in San Diego. He sold the company. I think he sold it near the last financial crash, but he did that business and he exited. But there's a lot of money in that business. And it's honestly a business that is, people don't realize that when they go around all these restaurants and these small businesses, they don't understand that most of those people are not going to a traditional Chase, Wells Fargo, Bank of America, because they're getting their thumbs down, like, we're not going to give you the money. And they need to have these debt markets open. So I know when the financial crash happened, like it was tough on the small businesses, because that market kind of dried up. A lot of people got scared. So that's a great sector to be in, not only for, you know, from a business standpoint, but you're also helping a lot of small businesses that can't get the regular help.
Exactly. And, you know, and then again, if you think about it, you know, from that kind of, you know, holistic view, right, we're trying to create some nice diversification, you know, inside of your portfolio. So this has really nice, consistent cash flow that's low. The default rate is less than 6% that we've seen over the past 6 years on this.
So to invest in your fund, it's open. Do you have a fund that's open so people can invest?
Correct.
Okay.
Yeah.
Do they have to be accredited?
It's a 506. It's a 506c.
Okay,
for accredited investors.
Is there a minimum for like that debt piece right there that you just talked about, like a minimum investment?
Yeah, usually 50K, like most syndications, is our minimum. Yeah.
Okay, cool. And so you said somebody put in 50, maybe $100,000. They're getting it sounds like a really significant return that's back pretty fast. It's cash flowing. It's a very good generator right there.
Yeah, correct. Yeah, we have 2 models. Basically, one is kind of the cash flow model if you're looking for the distributions that has a strong pref to it. And then the other is the growth one, where we're just taking that and it's like, you know, why do you want to interrupt something when it's growing so well, right? So if you do say 24% in one year, you want to just grow that the next year because you can compound right on top of that. So we keep cycling that. So we have a growth class in it as well.
And how long have you been investing in that sector of like the business?
That's been this year.
Yeah.
You know, once we saw, so that industry is actually growing by a 15% combined annual growth rate, which is just huge. But when the banking crisis happened, you know, we knew it solidified. There's a really nice opportunity here, and then how that could fit into the overall, you know, what I would call the ideal, you know, portfolio mix, right, for investors.
And then question on that, sorry to keep hammering. It's just it's interesting because a lot of people don't know about that. They don't invest. Do you think that business does better or worse if you have a slowdown, recession?
Well, look, the returns, I can tell you that the returns have averaged over 30% the past 6 years, and that includes the pandemic.
Wow.
Right. So now there were some businesses like, you know, for example, one of the businesses was the airline catering business. Right. And they were shut down. Right. And so they couldn't pay. Well, you know, rather than just kind of, you know, foreclose on the loan and everything, put them into a collection situation, we worked with them. Right. And said, hey, look, let's just modify your terms and everything. Let's figure out, I mean, planes are going to be flying again. And we know that, right? So let's just give you a little bit of grace period here. And, you know, we managed to, you know, basically salvage, you know, the entire thing. So I think we have some good flexibility to work through some things. But if we can get through that black swan event of the pandemic, we can certainly get through any industry downturn. And the other thing that I find just from like a managing your risk perspective is, I mean, we're literally diversified across like 20 different industries. And then we never take more than, say, a 5% position in any given loan.
Oh, wow.
So, you know, so it's really nicely diversified.
That's cool. I like that. Yeah. I mean, I know, yeah. I know the person that ran it, and I know you can make really good money, but you're helping small business. So, you know, that's a great business to be in for you guys. So you mentioned the term, which I thought was cool, infinite banking.
Yeah.
And I want to go back to that. I was kind of reading up on that. That's pretty cool. A lot of people don't know about it. I do know about it, but I kind of wanted you to dive a little bit more into that, like how you guys are helping people out in that and what that means.
Yeah, Kenny, I know it's a new concept it's been around a while, but I think there's just a lot of misunderstanding in the marketplace. And I love to just simplify things for people. I mean, why make it, you know, complicated? But there's just confusion in the marketplace. And I really got into this about 10 years ago. You know, when I was looking to, you know, I was investing in real estate and these other things, and I wanted to be able to do more, right? So how can I do that? And over the years, I've learned also that one of the key things that the ultra wealthy do anytime they invest $1, they're actually having that dollar do multiple things for them. So we're always conditioned to be saying, hey, what's the ROI? What's the yield? If I invest 100 grand and I can get a 9% return, okay, that's my return. Well, what infinite banking is it's a whole life cash value policy that you in life insurance, right, that you can take out on yourself, and you actually fund it with capital that you have, and you can set up, you know, flexible terms. You can fund it over 5 years. You can kind of fund it up front, things like that. What's really cool is as you fund this policy, the cash value grows in it. It compounds tax-free over time. Okay. So you're never going to have to pay taxes on it. You can create a reverse income stream in retirement. You actually loan against the policy and then create an income stream that comes to you that, by the way, is never outpaces the accumulation growth. So you could live to 130 and never outlive your money, right? Which is really cool. It's also creditor protected because it's considered life insurance. So if a creditor, you know, one of your kids gets into a car accident or something, they can't even see those assets. You've got, you know, credit protection. But one of the biggest thing that I think is really great in addition to that, you know, especially being, you know, an investor, an entrepreneur, is that you can loan against this policy. So let's say I found that next real estate opportunity that I wanted to invest in. Well, I mean, we all know what happens with money that's sitting in our checking or savings account. you spend it. I mean, it just goes. Right.
Yeah.
So this is a place, a place where you can store your capital. That's like one layer removed from your savings account. You can get access to it with literally, you fill out a 1-page form and your funds will be transferred to you within a week. Okay. But it still takes that extra measure. So this is where I keep my 12 months of living expenses, in case, something were to go wrong. Right. Because keep in mind that money is compounding tax free. Right. I can also, by the way, give it to my heirs tax free. I can loan against it. So when I want to loan against it is when I find that next opportunity that, everyone talks about dry powder in real estate. You got enough dry powder for that next deal. Well, where are you keeping that dry powder? And that opportunity might not come around for, 9 months, 18 months. Well, I want to put it to work. Right. So this is the ideal place to put your dry powder, have it working for you so you have more velocity and more protection in your overall wealth strategy, and then just pull it out when you need it. By the way, you can use it for anything. Like I would have used it to pay for my kids' college, or, to use it as maybe you're trying to do a down payment, on a house. And a lot of people take it even, you could buy a vehicle with it. Right. So you take cash, buy the vehicle, and then whatever would have been your loan payment, you actually start paying back into your policy and pay that down, because the accumulation value continues to grow all the time versus if you're paying the bank the interest payments.
So let's just take a scenario. Maybe you can just, some general scenarios. Let's say somebody's got $1 million sitting in an account. They're just waiting to invest it, right? A lot of people right now, they're putting in a CD, they're putting in a money market account, they're putting in T-bills, maybe short-term T-bills, getting 5-6%, whatever it is. The other alternative is you could actually take that $1 million, you could fund that whole, you could fund it right there, just boom, put it right into that account, correct?
Yeah, it's called paid up additions. So you can fund it, up front.
And then let's say it's sitting in there. We'll talk about the return in a minute. And they want to come back. I always say come back to the well, which is where the money is. They want to come back to the well. They've got a deal they want to invest in, and they want to pull some money out. So what does that look like? Is I put the money in. What is a typical return on that? And then also, how much money can I take out, and what is that interest you're paying? Kind of like, what does that look like to just because I think a lot of people now is they're sitting on cash, and a lot of people are starting to realize, wait a minute, like maybe I shouldn't always just use my cash, because then it's gone and it's like it's in and I can't get it back out. Maybe there's a smarter method, right? And that's what you're kind of saying here. And like I always tell people, Elon Musk, Jeff Bezos, those guys, they don't take salaries. They just go pledge against their $300 billion, and they take the money, and then every once in a while they sell it. But this is almost something like that. So if you can kind of walk through a scenario of what like $1 million would look like.
Yeah, you are right on the money, right? Because basically what you're doing is you're creating so much more efficiency with your existing capital, and you are probably not really making much off of it, right? The way typical people do it. So number one, also, we have lots of investors who are entrepreneurs. They sold their business and now they've got 8 figures, and they're like, well, with the banking situation, you don't even want to put you don't even want to take your $1 million and put it in the bank.
Exactly.
Right. Because that's actually at risk. Well, these life insurance companies, and I would refer to it as it's a mutual insurance company, not a stock insurance company. They've been around since the Civil War. So they've managed through many recessions and everything. So they're very, financially secure. But if you take that capital, you put it in here, and now it's growing. We're seeing, all of these policies, depending on the provider, is a little bit different, but, probably just under a 6% return, right? That you can get on that. And so you put it in, and there's also, you do have to fund the premium, right, of the life insurance. There's a percentage, could be 20% that you're funding in the early years. That is going to come out. You're not going to have accessible out of that $1 million. But, typically you have about 80% of the value that you have. And then again, whether it's in 6 months or 16 months, You can borrow against the policy, which is a very simple process. No questions asked. You can do anything you want with that capital. And yes, there is an interest rate, and they're all varying, but the insurance companies they move much slower, right, than the way the Fed is moving and everything else, right? So there's typically usually a little bit of a spread, maybe a half point or a point spread between what you're getting and what the interest rate is. So you create a little bit of an arbitrage, but just think, right, that million, even if you borrow 800 out to go invest in that next deal, or you're paying the interest, a million is still the accumulating value, right? So that's what's really key. And why a lot of people have a hard time looking at this, where again, they're just saying, well, if it's just about a 6% return, yeah, I can do that in, treasuries or something right now. In short-term treasuries, I'll invest in there. But just remember, what is the value to you of having access to your capital, having tax-free compounding? You've created estate planning by giving it to your heirs tax-free. And oh, by the way, you've got death benefit, right? Yeah. That's in there as well. And it's credited protection. You can also use it as collateral. So this is also a really nice technique in real estate, right? You're trying to put up collateral for some of these things, and you can just show the cash value of your insurance policy. So that's really strong as well. So when I start to stack up all of those things, for me, it means a lot, right, than just the actual return that I have there.
Yeah, I think that's what people are missing, is that money's sitting there working. So if you're taking it and, if you're making 6% and they're charging you 7%, you're really paying a minimal fee for that money, which is a joke, and it's still working. And so if you ever go to pay it back or something, so it's, so I think people, it's a good thing for people to think about, because now you're working the money twice,
Exactly. And let me give you one other quick example, how cool this is, right? So my daughter is 24. She's only 2 years out of college. We set up a policy for her when she was in college, and, she was working and everything. It's like, well, where are you going to put your money, right? Well, we set up the policy for her. She only has to invest $10,000 a year. And if she just invests $10,000 a year, the time she's 65, she'll have accumulated over 2 million and have almost 100K in income coming in. And in addition, isn't that amazing, right? If all you did was invest,
it's like a car payment every month.
A year.
Like a car payment every month. It's like a bill. Yeah. Make it a bill. Yeah. Pay it. Yeah.
Exactly. But she took it even further, which was amazing, right? So she, we mastermind a lot in our household, and, we were talking about real estate investing. So she graduated college, and her boyfriend ended up buying a house, which they went in and they totally house hacked it, built up 100K of equity. And then they used the down payment to buy the house with the down came from the life insurance policy. So now they went and bought their second property, which they're doing the same thing in the second property. And now all the cash flow from the first one goes right back into the policy to refund the original payment and then keep going and accruing. So it's a real rinse and repeat strategy. And if someone at 22 can be really effective at doing that, wherever you are in your journey, you can as well.
Yeah, I set up, I have 2 girls, they're young, and I just set them up for them and started putting money in. And since they were born. So by the time they get to whatever age, we're putting in their same thing. It's just like you can borrow it that I'm like, they can just keep funding the thing is that they want, or we just keep going. I always tell people a lot of this stuff, people overthink it. A lot of people are negative to it. And I said, it's nice to have different things. Think of it like a bill. Just pay the bill every month. You pay all this other crap. You buy all this stuff you don't need, which isn't financially helping you. And at the end of your life, you're not going to be mad that you paid this bill and you're going to go, oh my gosh, I forgot we have this bunch of money here that we can either gift to somebody or we can use or whatever. I think people just don't realize the compound of that over time.
Yeah, absolutely. And then just kind of, going back for a second, right, from a perspective, when I was talking about studying the traits and the habits of the top 1%, this is literally a cornerstone to how they build and protect their wealth. All these I spend a lot of time with family offices, groups, ultra high net worth. They all have this in place, like completely. Right.
They buy like a lot of money in these. You can have a lot of money in these, right?
You can have a lot as much as you can put in, you can set it up. And by the way, this is really fascinating. I don't have the actual statistics, but in the past 12 to 18 months has been one of the biggest increases actually in life insurance because of all this volatility, right, that we're seeing in the markets and, no matter what sector you're in. So even more inflows, are going into here.
So I wanted to jump in and talk about real estate. I know you're investing in that. Are you kind of chilling on real estate right now, just observing? What did you guys invest in? Just kind of getting just kind of a general, like a 30,000 foot view of where you're kind of looking at real estate today. And what did you guys, what have you done prior?
Yeah, absolutely. So, we're typically looking at multifamily. I think that's, the primary asset class that we're in. We also do self-storage, and we're always looking at interesting things, everything from parking lots to mobile home parks, right? The other kind of offshoots. But I'd say multifamily is our core. And it's been pretty interesting. I've heard a couple of your updates and assessments on the local markets, out there in San Diego. And I live in the Florida market, which is, booming out here right now. So you have some of these pockets like Dallas, Phoenix, things like that have been, seeing lots of demand. But I got to tell you, we were just, so I was sitting down with my portfolio manager this week, and we have underwritten so many deals or gone through the analysis, because our model is that we're not an operator. So what we do is we create strategic partnerships with top operators in top markets that we like, and bring those deals to our investors. But we're looking at it from the investor perspective. And I got to say, we've seen a lot of deals, right? There was kind of no deal flow in the beginning part of the year. Now we're seeing like lots of deal flow. And I think people, operators, they need to do deals, right? Because they're in the business to be collecting those fees and doing deals and things. But we have not seen any hell yeah kind of deals that we want to get in. And we're starting to even see distressed deals that are marketed that way, but we still think they're overpriced. And the other thing that's a real gotcha people don't realize is the amount of capital on the front end that is going towards the cap. It's going to pay for the cap rate, right? Or the
the adjustment.
Exactly. Right. So, that is really expensive. And so we're having a tough time really finding, really, nice deals. I think maybe those are going to surface within the next 12 months. There is a lot of, loans coming due where people were doing, bridge debt. Everyone was doing bridge debt, right? So if you did your underwriting 3 years ago and that's coming up soon, it could be, sticky. So I think there's going to be opportunities probably in the next 12 months. I heard your forecast on the, interest rates as well. I would concur that they're likely going to come down. As soon as interest rates start coming down, that's going to start to relieve some pressure. People can, refinance. Is the rate cap? I'm sorry, the rate cap is what I was talking about. That cost, take a look at that cost when you're looking at deals, because that's just a sunk cost, right? That as an investor, it's not going towards value add. It's not going towards anything really.
Yeah, the market's interesting. I do study data a lot and watch. So I kind of gave like a prediction. Everybody's like, what do you think of the rates? I just threw out a prediction out there, but I was looking at the Feds and what they thought. But, I think even today I was listening to a lot of people because the Fed just spoke. And a lot of economists and other Fed officials are really just kind of like, have they gone too far? And are we looking in the rear view mirror? But obviously things are coming down. But I do agree with you. We were at, I won't say the name of the person, but we were at an event and we were like talking to one of the guys that does a lot of the debt, and he knew we did the financing. So we were talking shop, and I said, hey, so what kind of debt are you doing today? And this is probably a couple of years ago, and it's not surprising. He goes, we're doing, 80% of our loans that we're doing is bridge. Okay. And it's adjustable. I said, well, what were you doing 5 years ago? He goes, 80% of our loans were regular Fannie, Freddie, life insurance, put the 35% down, that kind of play. And so you saw the market move, like you said, from that traditional to the bridge. And then on top of that, I don't know if you ever listened to a guy named JP Conklin, the rate guy. You ever heard of him?
We've been working on this for the past few months. You know, we always want to bring as much value as we possibly can. And our partner, Prime Corporate Services, is all about bringing you a service you can't get anywhere else at a price you can't get anywhere else. Whether you're new to owning a business or owning a property, or you're an experienced property owner or investor, Prime Corporate Services is not only going to help you, but they're going to make the process so much easier. So if you book a call, the first thing they're going to do for you is help you understand what your business structure should look like, your corporate structure, tax planning, estate planning, all of that. Maybe you're saying, I'm brand new to starting a business and all this sounds foreign and complicated. Remember, this company helps new people just getting started every day. They're going to help you form the entity that's best for you and walk you through the process. Before I found this company, we paid thousands of dollars to other attorneys, CPAs, and consultants to try to understand exactly how we need to be structured to be as protected as possible. We've also gone the other route and used online platforms to form entities which unnecessarily put us at risk. You guys, you don't have to do that with this company. They'll do all of these things for you at a reasonable price, so you never have to think about saving money at the expense of exposing yourself to liability. We've searched high and low, and you will not find this much value anywhere else. All you have to do is schedule a free call today. Just go to primecorporateservices.info/GITCG. Once again, that's primecorporateservices.info/GITCG. We'll also leave the info for you in the show notes.
Yeah.
Okay. So listen, his podcast, he had, he helps people with the rate caps and all that, but he had a client, I think they sold, a lot of people plan, they bought the properties, they're going to hold them for 10 years. And then the market moved. They decided to sell them in 3 to 4 years, paying a lot in the yield maintenance prepays as they sold. One of his clients sold all these buildings and, all this money. And I think a lot of the big guys, they started doing the Freddie floaters, and that kind of trickled down to other people. And so a lot of these guys that did that thinking, well, worst case is I have the cap. I mean, how high can rates really go? Well, I think they realize how high they can go. So like, that's what you're saying is people don't understand what we're talking about is people got into these deals, kind of were following this model. Everybody was kind of doing it. And a lot of people, they have to go out there and raise money, not even to keep up with the cap payments, the difference, or they have to raise money to also say, hey, if we refinance this property, we have to come in with money. So that's a hard swallow and a hard pill to, call your investors and say, hey, and a lot of them are kind of like, I have friends that did the syndication and they're having to give properties back, or people, investors are like, we're not going to give you any more money. So it's a sticky situation. And that's where you're thinking in the next, year, those sellers or whatever are going to have to start getting realistic because they're going to have to sell eventually because the rope's going to come to an end and they got to do something.
Yeah. Yeah, absolutely.
So I wanted to jump into your kind of like the mindset of what you got going on, but also, and I think it's around the book you just launched, and talk about that because, you mentioned freedom of money, freedom of time, freedom of purpose, freedom of relationship. And I'm guessing your book is talking about that, but I kind of wanted to talk to you about that because I think as we enter times like this, where we came out of the pandemic and for some people, life is hard, they go through challenging situations. We always kind of revert back to, man, I should have done that differently. And it's not just about money. They're looking at their time, they're looking at their freedom, they're looking at their health, their relationships. I think of a time, especially the pandemic, a lot of people had a lot of time to reflect on themselves. Which I think is, can you kind of jump into about the book and kind of the concepts around like what I just mentioned, those, topics within freedom?
Yeah, absolutely. I love the topic of investor psychology because, as I go through my journey, we talk about passive income. Well, you have to keep asking why do I want passive income? Well, you might be in a W-2 job that you don't exactly enjoy. So it's really because you're looking for freedom of purpose, actually, which is to be waking up every morning, doing something that you love to do, right? Or maybe it's freedom of time. Maybe you're an attorney and you're working 80 hours a week and you have no time to watch your kids grow up or be involved in them. right? So you're trying to think, I've got to drive more money to create passive income or whatever it is to basically buy my time. Right. So I think these, and these are really coined by Dan Sullivan from Strategic Coach, who's my mentor. Right. These four freedoms are really, I think, at the core of what people are looking for. And I think, that's kind of, the premise really for the book, right? And then in the book, I tried to make it very pragmatic that people could actually make progress on their journey. So we have 5 distinct phases, which are all underpinned by creating your vision. Because if you don't have a target, you're going to miss every time. So you want to get crystal clear on what your vision is for yourself and for your family. And then we start kind of working through these different 5 phases.
What do you think really separates? I mean, you're in the military, so you're around that world, right? And then you came out and you kind of probably got, I think you said you kind of got the job. And then now you're in a world where you've created your own freedom with all this stuff and financial freedom and freedom of time. And then now you're in a world where, like you said, you just interviewed the guy of, I believe, Tiger 21, which is around all these wealthy people, which is a completely different mindset. But when you kind of look back at your life and you're kind of looking at the Dave that was when you found out you had the triplets, to now, what do you really, and you're talking to that person or somebody that might be listening to this that's starting or trying to get some financial freedom, or they're in the job and they're like, man, I want to get out of this. What's some things you can just give that person where you've come this far, what you've learned that they're just not going to learn just from hanging around the average person that you've been able to kind of be by hanging around all these, they're not gurus, smart people, just all the people that you're around?
Yeah, excellent question, Kenny. And that's actually the first phase of the holistic wealth strategy. It's mindset, right? Because what is the difference between Elon Musk and then that guy you went to high school with who lives in the same town, has the same set of friends and the same job, right? It's all mindset, right? So how you really kind of think about things. And even if you don't have capital, you can always make money, right? But you have to have the right mindset to be able to get there. And if you have that vision, is what helps you break through walls with your mindset, right? And create opportunities out of thin air. So we also run a mastermind and virtual family office. And it's amazing to see, the opportunities, how people are taking this wealth strategy framework that we have and just literally 10xing their wealth. Like, it's amazing. And I'll give you a quick example, to make it real, folks. So we had a new investor. He read my book, totally loves the book, wants to implement the strategy, put all the pieces in place and everything. And then he's attending some of our sessions. And then, you've only got so much capital, right? It's like, okay, I can redeploy my 401k. I can do this. I can do that. Well, in the context of trying to reduce, create capital, create cash flow, reduce taxes. He ended up learning, we talked about the fact that short-term rentals is also an offset against your active income. So he found someone who taught how to do short-term rentals. Long story short, he ends up buying $1 million plus property, no money down. He worked with this guy to help identify the property, so reduce the risk there. No money down, $1 million property is going to reduce his taxes by over $100K this year. He's cash flow positive on this thing, and he had no money down. I mean, right? I mean, that is just brilliant, right? But you have got to have the mindset to be able to connect the dots and realize that you can actually, create things out of nothing. You can create things out of actually new relationships that you can create, new things that you can learn. So yeah, that's really at the core of it.
Yeah, and I always think too, just what's helped me a lot, I'm sure you, is a lot of people, I tell people maybe the first step is if you have money, like a young kid, I said, hey, if you have 20 grand to invest, you should probably just invest it back in yourself. They go, what do you mean? I said, just get in the right rooms, get around the right people that have already done something, because just like you're who you're around, the proximity you're around is who you start to become, whether it's money you're looking for, whether it's health, whether it's your relationships, it's all right, all the above. So I think getting yourself in those rooms really is helpful for all of us to grow faster and make smart moves with money or all that stuff. Has that kind of been an impact on you, just getting around the right rooms, around the right people? Like, what of a difference has that made in your life?
Yeah, 100%. I mean, you're a product of the 5 people that you spend your time with, right? As Jim Rohn likes to say.
Yeah.
And I'll give listeners like a nice little way that you can kind of, encapsulate what, our definition of net worth. Net worth is equal to your financial IQ plus your mindset IQ plus your physical capital plus your relationship capital. When you can put all of those things together, that's how the billionaires are playing the game, right? So we talked about relationship capital. Also think about, so physical capital, what I mean by that is actually your health. Just think if you had 10 times the energy that you do today, whatever your age is, think about how much energy you could bring to your business, your investments, your family.
Yeah.
And you could also have, on the flip side, right? Look at Steve Jobs. You could have all the wealth in the world, but if you didn't have your health, you'd have only one goal, right? So investing in yourself is really key. And I think, that's also what's really foundational to this as well, is knowing that you are your greatest asset. So when you can invest in your health, you can invest in your mindset, your education, your relationships. I've always gotten more than a 10x return when I invest in myself.
Yeah, I think that's awesome. Dave, where is the best place people to find you, find your book, learn more about you? They want to get in touch with you?
Yeah, absolutely. If folks want to get a free copy of the book, they can go to holisticwealthstrategy.com. Or, if you want to check out any of our opportunities, it's at pantheoninvest.com.
And then question I always ask everybody is, what's your definition of generational wealth?
That's a great question. So to me, and like I said, I do spend a lot of time in family office circles and everything. And so generational wealth, like, again, I talk about wealth holistic way because there's all these other attributes to it besides physical money, right? And a key thing with that is values that you want to pass on to future generations, because oftentimes what you see in G2, G3 is that they've actually spent all the money. The money has actually created problems within the families. So ideally, if you structure a family office, you can establish those parameters around, really what are those values that you're going to pass on to the future generations in addition to the wealth. You're also setting up guidelines to how they use money. So another concept is setting up a family bank that you can do with the life insurance policy. So someone wants to start a business and then they have guidelines that they need to work through within the family. So I think, establishing a family office is really key for, those that are, heading towards ultra high net worth. And even if you're not, I mean, still, even if you have a couple million, I mean, just think about it, right? Passing on that legacy. How do you know that those values are really going to live on in the future generations, and all the work, all the impact that you've created in your life? Wouldn't it be great to, pass that on to others?
That's awesome. That's awesome. Well, Dave, I really appreciate the time. Congratulations on all your success and all that you're doing. And I think people sometimes underestimate what they're capable of with the right mindset around the right people. And hopefully they reach out, read your book, check you guys out, because you guys got a lot of cool stuff going on over there. It's not just real estate, but it's, I think, like you said, anybody, even if they have money, they're going to pass it and they're going to try to, multiply it. They really just need to get around the right people that are already doing it.
Yeah. Awesome. Really appreciate the opportunity to connect with you and your listeners, Kenny.
Yeah.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.